Good afternoon, everyone, and welcome to the Behind Closed Doors webinar. We're very excited to have you with us today as we share practical insights on valuations, deal structure, and how business owners can prepare for a successful exit. Our speaker is Mr. Ahmed Ibrahim, the CEO of Transworld GCC, a GCC entrepreneur and investor with 20 years experience leading major oil and gas development, investment projects, and strategic advisory roles across the region. Welcome, Mr. Ahmed, and the mic is yours.
Thank you, Abdurrahman, and I want to thank everybody who has joined us today. We promise to make this webinar insightful and to make your time worthwhile. To start with, so what we're focusing on today is $10 million plus exits. So these are the exits which we call in the industry, in the mergers and acquisitions industry, we call middle market. So it can be from 10 million all the way to about $150 million, basically. And we want to talk about important aspects of these transactions with regards to timing, how to handle buyers, what buyers are looking for, and more importantly, or most importantly, valuations. In terms of housekeeping for this presentation and this webinar, we'll be taking questions at the end of the session. We'll have a Q&A session, and just raise your hand or write your questions through the chat box. One of our team will pick up, either will give you the mic to speak, or we can give you, or you can pass the question on to them, and I will take that question. So what are we going to talk about today? To start with, we're going to give a quick overview of the state of the M&A market in the GCC for this year, for 2025. We're going to talk about some mega deals that have happened and the shifts in different sectors. Thirdly, we're going to talk about mistakes that kill exits. So what are the mistakes that we see in different transactions? And we'll give you a few examples, some of which are public and some which we have dealt with ourselves. And then we're going to have finally, we're going to talk about a planning or a strategic exit planning framework. So a playbook of how to basically maximize your exit, maximize your valuation, and basically also have a successful transaction. So in terms of the market in 2025, what we've seen in terms of headline numbers, deal volume has increased, by 31% this year on last year. Deal value has gone up by 66%. Year-on-year growth, we're looking at a 149% increase. The UAE was the top destination in the region, in MENA and the GCC. It attracted close to $40 billion of M&A flows, and it was followed by Saudi Arabia, which had inflows of about $4 billion. These are the most active markets which we've seen in this year, and we expect these trends to continue in the years ahead. We think also that Saudi Arabia will be playing a larger role and a larger place in the market going forward as we see the diversification of the industries and diversification of the economy growing in Saudi Arabia. So why is this important for you as a business owner? It's important because when the market is active, like we just demonstrated, that helps valuations go into an upward trend, because when business is growing and then we see more demand on transactions, more demand on M&A, more demand on growth businesses or growth opportunities in general. Larger conglomerates or larger players look to acquire market share, and we're seeing more of that happening now, especially where organic growth for a lot of these companies is coming hard, and they're looking at ways to grow through acquisition, basically. And so it affects you as a business owner because there's an opportunity to sell if you want to at a higher valuation. Okay, the opportunity has a window. We think that the window right now is very, very good for selling a business in the region. This is specifically for the Gulf, but also for the wider MENA region. But the Gulf in specific, which is our focus for today's topic, we deal both in MENA and GCC, but for this topic and for this webinar, it's the Gulf. The momentum which we're seeing now is unprecedented, to be completely honest. So maybe 10 years ago, we would rarely see M&A transactions happening in the market. You would rarely see the type of momentum which we're seeing now. A lot of larger conglomerates are looking, and the larger business owners are looking to acquire market share in different markets, to acquire either competing or businesses that can integrate into their existing business. Also, there's a lot of private equity funds that have grown in the market. In the last 10, 15 years, the private equity industry has grown, and these companies or these financiers, they're looking also for opportunities. And a lot of the industries which we see that are very hot or very in demand are manufacturing, healthcare, and education. Other industries, of course, we deal with, as in construction also, and retail or F&B. But these three, which I mentioned at the beginning, are the most in demand right now. So a few deals which we want to highlight for the year. This is outward. The first one is outward from the region to global. So this is ADNOC's acquisition of Austria's OMV. Okay, and it was $16.5 billion deal for Borouge. So Borouge is a part of the ADNOC group. They are looking to basically integrate this into their overall portfolio and to grow their business through this acquisition. Another one, which is an inflow into the market, which I don't know if many of you have heard of this transaction. It was Titan, which is an India-based jewelry company, which bought a regional jewelry player, which I'm sure many of you have heard of, Damas. They bought it for $283 million. And this is another example of basically foreign capital coming into the market, buying market share in a company like Damas, which has been operating for over 100 years. And so quickly they're getting market share for 140 stores, which Damas operate in, and they've grown their market significantly through that in a very quick way. Another exit which we want to talk about, or transaction, is we've selected these transactions just to note that they're all different types of transactions, just to give you a flavor. There's many transactions that happened, but these are transactions which we would like to highlight on, so you can see that the different types of transactions happening. So Gulf Capital, which is a private equity firm, okay, they sold Kuiper Group for about $10 million to an Indian buyer. And so what we're seeing is also private equity firms which have been in the market for about 10, 15 years are also in the process of offloading their assets and moving on. And when they do that, usually they have new capital for new acquisitions, and that also forms an opportunity for sellers to sell their existing asset to them. So at Transworld, we want to show you exactly what we've done for an existing transaction which we recently completed, and so we want to give you like a case study of what we can do for you as a client if you're willing to if you go into this journey with us. So obviously we can't mention specific names because of confidentiality. We always operate under very strict confidentiality rules, make sure that our clients' data, our clients' information is protected. So in this particular case study, we had a Dubai-based leisure brand. They were looking for a buyer. so that with both financial strength and strategic vision, someone who can scale the platform while preserving its innovative DNA. What we did, okay, we set the valuation at a reasonable price, which at this point, in this case, was a 3x EBITDA. And this was aligned with multiples. And this is one of the issues which we will talk about later, which is valuations, and having valuations which are reasonable and which will help you sell. It's in our interest as an advisory, if we're representing you as a seller, to get the best price for you. Okay, but we need to also be realistic, and we need to have valuations that actually sell, that can actually work. So what we did after we set up a reasonable valuation, we came up with a target buyers, and we approached them confidentially to see who would have interest. After that, we did a rigorous screening for their credibility and their experience as investors. The next point was we're negotiating with them on alignment with the business and on their offer and the terms. Finally, once we went ahead with one of the buyers, what we want to do always is create competition between buyers so that we can get the best price and best exit for you, the seller. So once we had different competing offers on the table, we worked with the seller to make sure that that seller selects the right buyer to go ahead with. Once we signed off an exclusivity with that buyer, we had a due diligence process that went through 21 days only. And the reason why we could finish it within 21 days was we had a very well-documented, well-structured data room. So basically, a data room is where all the data of the company is put, financial, operational, HR data, all the data, all the issues, all the things that we know that a serious, educated buyer would look for. And we made sure that we can go through that whole process within a 21 days period. And we would support throughout that period with answering questions from buyers, making sure if any requests are answered promptly. If there are any observations, they're taken directly to the seller team. Make sure it's done before too much time has passed. And so we were successful in finishing the due diligence within 21 days. And then finally, we spent probably somewhere between 2 to 4 weeks finalizing SPAs, share purchase agreements, and the transfer was completed on both sides. The transaction was closed, like I said, in just 6 weeks. And that's not the benchmark, just so that nobody thinks that is. This happens sometimes when we find the right business for the right buyer, and the buyer is serious and is ready to, and has experience in buying companies or in mergers and acquisitions. And that's why we were able to finish in 6 weeks. The seller got what they wanted. More importantly, also that staff, which was with this seller for more than 15, 20 years, were retained. And the buyer also got a platform to start their expansion from. What this transaction demonstrates is that we can, when we work with the right seller and we find the right buyer, we can deliver fast and discreetly, and we bring outcomes that we get the outcomes we want. We can basically take complex exit into a success story quite quickly. We need to understand when we go to the market with a company, what buyers are looking for. So mostly buyers are looking for these 3 things: scale, legacy, and strategic positioning. So your business is not just the financials. So it's not just numbers. It's not just our EBITDA, for example, is 10 million per year for the last 3 years. There's more to it to that, and that's what our team, once we engage and we have an engagement letter signed with you, that's what our team helps to do. We need to pull out the story of the business. The business, for example, How many, what kind of heritage do they have? What kind of clientele works with them? How much clients, what do clients look for from this? The operations, the employees, all of those aspects are taken into account. All of those aspects of the business are highlighted so that a buyer can see the real value in this business. So the biggest mistakes that we see that sellers or founders do, and what that basically they can, by doing these mistakes, they could risk either not exiting or exiting at a loss or at a lower valuation in the future. So the first mistake is waiting too long, the timing risk. So we have two case studies here. One of them was Namshi, which in 2021 was looking at a valuation of $600 to $700 million. The valuation and that there was a misalignment between the buyers and the sellers at that point in 2021, and the sale didn't go through. And over a year and a half later, the company sold for half that valuation. Similarly, Yahoo, which is a more, especially the older crowd would know about Yahoo, which was basically the precursor to Google and was the biggest search engine in the world in the year 2000. It was a listed company at $125 billion, and the market changed. They lost market share, and by 2017, they were bought out by Verizon for $4.5 billion, basically at less than 5% of their original value. Valuations are not constant. They change in time. Waiting for the perfect valuation might not be the right thing. There's sometimes basically things that happen in the market that you can't predict. For example, 4 or 5 years ago now, COVID hit a lot of we saw COVID hitting a lot of retail businesses, for example. Other businesses were positively affected by that. So waiting for the right timing basically is not the right thing to do. If you wait, you might miss the wave, you might destroy value in that process. We have other examples of clients which we worked with that passed on good offers and only to come back to us a year later and sell the company for half the price. And because things changed in their circumstances, they had to leave, for example, the country, or they had some issues, they had some health issues that made the business suffer, and they didn't have a succession plan for the next generation, and the business was sold for half the price a year or 2 years later because of that. So valuation, timing, you should not take, you should, the best time to sell is now. The best strategy to take is to come up with the right valuation, to go out into the market and go out and explore these offers seriously. So this leads me to the second mistake, okay, overestimating valuations. So holding an unrealistic number in your head. A lot of founders which we talk to day in, day out, they think their company is worth way more than it's actually worth. A lot of times it's because of emotional attachment to the company. It's because the company, they put so much effort into it, or it's their baby. They've been nurturing this baby for 15, 20 years, and they won't let go easily. The facts are the market is willing to pay what the market is willing to pay. So end of the day, that's why when we work with you as a client, we make sure that we go out into the market with the right valuation. We gave an example earlier for 3 times EBITDA for a very traditional business. For a growth business, it could be maybe 8 times EBITDA. For a very large niche business, it could be 10 times EBITDA. It depends. We execute transactions in all industries globally, and we have benchmarks which we see, and we see basically close to 5,000 transactions a year, and those transactions we help us basically benchmark what the right price for this business is based on its tenure, how long it's been around, based on their financials, based on how stable the company is, and how long this company has been operating, the structure, the governance, many aspects which we take into account. The third mistake, which many founders do, is they neglect to prepare. So they go into the whole selling your business process without clear financials, without a clear data book, without succession planning, proper governance, or very high customer concentration risks. So very recently, we had a client who was looking to sell their business. We had an engagement letter. We got a very serious buyer on board, but because they had one client for them, for that business, that represented anywhere between 70 to 75% of their revenues, the investor and the buyer basically backed off from that business because it was too high of a risk. It was too much of an issue. What we did now in the process is we said, okay, we're going to address that issue. We're going to address specifically how that customer concentration is going to be addressed over the long term. We're going to make sure that if a buyer comes in, they understand that that customer is not at risk. They will not lose that customer within a 5-year period. We can put some guarantees, some processes in place, and this is what we're helping, how we are helping this seller or this business to exit and to find a suitable buyer. So in the next sections, we'll talk about what we need to do to avoid these mistakes. This is the strategic exit planning, our framework. We've seen now that how the market is active now, much more active than it's been in the last 5 to 10 years. And we're also seeing that what mistakes can lead to. Now we're going to talk about what the right framework is. So we break down this framework into a 3-step process. So we start by step 1. We identify and act on the right timing. We benchmark against recent transactions in your sector and geography. We look at the sector multiples, what kind of buyer appetite is there? What does the macro environment look like for this specific industry? We look at exit readiness, okay, for the next every 6 to 12 months, so that we're continuously looking at when is the best time for you to exit. We basically recommend for every founder to assess themselves every time, also even before involving an advisory like ourselves. We think it's a good process to basically do your own assessments, understand the market. We are very happy to give any seller a free consultation. We can speak to you, talk about your industry, what we've seen, and basically what your business is. We think your business should be worth at this stage and what we can look for in the future. The second step is building a credible valuation story. So basically getting an independent valuation from a recognized firm. Okay, at Transworld, we can deliver this through a detailed initial assessment and a business valuation that we can use to ensure that the valuation is anchored in market realities. What we can also do when we get further into the process is we can help bridge expectations on valuations through an earnouts or stage exits. So sometimes what we've worked with clients is if they're looking to exit, for example, over a 5-year period, we can have a sale of 20% over time, and we use that as a process so that we can get a higher valuation as the business matures. The last thing which we need to do is we need to prepare for due diligence. So we need to have audited financials, clean financials. We need to have all our tax documents. Now here in the UAE, we have corporate tax, but also throughout the GCC and the MENA region, the tax compliance and tax issues have become much more prudent now. It's maturing, and most serious buyers are looking for tax documentation before they move. We need to diversify customers and revenue streams. And more importantly, we need to also document key processes. Buyers need to understand that if they buy this business today, that they can, after the transition period, they can continue working this business, they can continue growing this business, and that they can see this business to the next stage. What we do on our side also, we would introduce your business as an opportunity to our qualified buyers. We have currently in the region close to 50,000 buyers in our database. These are people we are working with actively. There are different entities and different sizes. So there are everywhere from entities that are associated with government-owned entities like, for example, PIF or ADIA, all the way down to private equity firms, strategic buyers, family conglomerates, family offices. But then even for smaller businesses, sometimes we have individual buyers that are coming from abroad that are looking to buy a business here. So we have a big array of different types of buyers that are looking for businesses in different aspects. We also can run a mock diligence. So it's an exercise where we do a diligence on the company, and we make sure if a buyer comes into this transaction, what would they do? How would they see things, so that we can preempt any questions. We have our own due diligence team internally. Our internal due diligence team does buy-side mandates, buy-side due diligences. They do also sell-side due diligences, and they're very experienced ex-Big Four team. The next steps would be to position the business with a narrative of growth. So we highlight in the documents which we would prepare for your business, what are the growth levers, how scalable is the business, the brand strength, the market position. We look to develop projections, and we see also the projections which are developed. We make sure that these projections are reasonable, attainable. We don't want to just build up financial models that can't be believed or can't be understood by buyers or investors. The last step we want to talk about is the advisory ecosystem. So this is what you need to do and why we need to do it. In order to reach a successful exit at the best valuation possible, there's a whole team that needs to be working. It's not just us. There's us as M&A specialists or M&A advisors, but you also need to talk to a legal advisor. Okay, a lot of times we need to get some advice from tax advisors and auditors and audit firms. We in Transworld, we can do all that on your behalf. We can help with securing the right legal firms. We can help with talking with the right tax firms, and even sometimes we talked with audit firms and accounting firms to help with your current systems and current processes. What you do by having a team like this is what helps you ensure that you can exit. A lot of times, what we've seen in the past, where we have clients that have tried to do this whole process alone, they've tried to go out into the market and they haven't been successful. And by the time they get to us, maybe say a year or year and a half later, when they've been trying to exit or trying to sell their company, the problem that happens is that a lot of times They've been in the market. A lot of market players have seen the company. They haven't seen it in the right light. They haven't seen it properly packaged like it should. What we always say, basically, that successful exits don't happen by accident. They happen when the founders and advisors work together to maximize the value you've built, basically, to maximize this, to create a story that is believable, the story that is credible, and the story that can pass through scrutiny through a due diligence process. Just a quick recap before we go into questions and answers. So the M&A market in the region is growing. We looked at a few transactions just to give you an idea of what's happening, some of the big transactions or some of the landmark transactions in the region. We looked at these transactions in different sizes, different industries. We talked about the mistakes that usually happen and that lead to a failed transaction. And finally, we put a framework which we believe works best to get a realistic transaction going through and get success as we want them. So we'll take questions now.
Sure, thank you, Ahmed. And we can take your questions. You can either drop it in the chat or the Q&A section, or just you can raise your hands and you can ask Ahmed any question.
Any questions from the attendees, Abdurrahman? Okay. I think we got a question in, or we have a hand. Can you take that question, Abdurrahman?
Hello?
Yeah.
You can. Yes, sure.
Yeah, hi.
What's your
Hi, Ahmed.
question?
Yeah, sure. This is Apoor Bajaj from Edibook. Really appreciate the presentation today. I have a quick question. Like you mentioned in the presentation that, there are three sectors: healthcare, education, and I think you mentioned retail or something, that are seeing
Manufacturing.
Manufacturing, sorry. Yeah. So that are seeing an uptick in deals in the region, right? So can you maybe give a couple of examples, if you know, in the education sector, what sort of deals are happening? Like, is it acquiring of the AI sort of businesses within the edtech domain or something like that, if you know?
What's
Little bit
happening?
of
Yes,
Yeah.
we're involved in some of the education transactions in the business, in the industry, in the region. A lot of what's happening, for example, is in private schools. They've been acquired. There's very high demand, especially in the Saudi market, for example, on private schools to be acquired. Multiples are now going somewhere on close to 12 times to 14 times for private schools. In the edutech side of things, we have seen existing operators of large education platforms that are looking to grow into that side of the business, to grow into the edutech so that they can grow their business further, not just through traditional ways. And so these are basically school and university operators that are looking for other ways to grow their business through acquiring an edutech business, basically. Does that answer your question?
I see. No, got it. So basically, legacy education, big companies trying to leverage edtech, like tech in the education domain, to probably grow their market share and scale it more outside
Yes,
their
exactly.
current physical business.
And they use basically their existing platform to dispel that technology to a further audience, basically, because they have a big platform already and they can use that. That's what they're trying to do. Some of what we've seen.
Got it.
Okay.
Thank you.
Abdurrahman,
Thanks a lot.
thank you for the question. Abdurrahman, any other questions?
Thank you. Yes, we have another question. It says, how long does a typical sale process take from the initial process to the close one?
So a typical process will take anywhere between 4 to 6 months from the time we sign an engagement letter, basically. So it starts with an engagement letter, and then We get all the documentation required. We develop sale documents like a teaser and an information memorandum. And then we develop target lists for the company. So who would buy this company basically? And then when we move into the next steps where we have buyer interest, we have an offer or offers on the table, we review those offers, and then we move on to offer acceptance, diligence, and then finally closing. So it takes anywhere between 4 to 6 months on a typical transaction.
Another question regarding the documentation. Someone is asking what's the internal documentations needed to impress or the needed to see by the buyers.
So buyers are looking for a lot of type of information. I mean, they're looking for obviously financial information. They want to know the operations of the company. They want to know what, sometimes very important to have an understanding of the leasehold. If it's a retail business, what is the kind of lease that is in place? What are the rights for the buyers and for the landlord? They want to know obviously what assets, if it's an asset heavy business, what's the condition of these assets, if there's condition reports. They want to know also the governance, what's the structure of the company, client information. So how many clients do they have? How do they acquire these clients? What kind of turnover of clients do they have? How do they retain clients? Is any one client, for example, represent a large part of their revenues? All of these aspects they're looking to see. And that's what we will be asking them through our information request list. Our information request lists are very detailed and they're very specific to industry. So different industries are requiring different types of documentation. Buyers look for different things in these companies.
Perfect. I think we answered all the questions. And if anyone also have any other questions or want to know more details, you can send us an email, or we'll send you also a meeting link where you can schedule your confidential call after this meeting. And thank you everyone for attending, and thank you Ahmed for this briefly and well-detailed presentation. Thank you so much.
Thank you all.
Thank you, and we can see you also later in more other presentation and more other documents and more discussions. Thank you so much.